A very good evening to all of you. We once again welcome you to Tax Talk, which is conducted on behalf of Ranaweera Associates. And as you know, every time we have Tax Talk, we have an expert who is known in the industry for taxation and consultancy in accounting field. He's no other than Mr. Athula Ranaweera, who is the Senior and Managing Partner of Ranaweera Associates. So without any further ado, let me introduce Mr. Ranaweera once again to conduct today's Tax Talk session. Good evening, Mr. Ranaweera.
Good day to everybody.
So, Mr. Ranaweera, I think today we have a very important and very very current topic. It's about the amendments made to the Inland Revenue, bill, which was passed out probably last week on the 18th of March. Can you give an introduction to this topic, Mr. Ranaweera? What exactly are the professional review? What's your professional review on this Inland Revenue amended bill?
Yeah, as an introduction, now the Inland Revenue Act number 24 of 2017 passed effective from 1st April 2018. Now we have already applied that law for last 2 years of assessment, and we were waiting for various amendments announced by the government, as well as certain amendments announced through the government budget 2021. And to accommodate all these things, they released a bill, the Inland Revenue Amendment Bill, on 18th of March 2021, and they have the order filed in the Parliament on 26th March 2021. 26. As a result, if somebody, it is to be discussed after 1 week time in the Parliament. Then this is, as I mentioned, this is a long-awaited amendment. This comprises so many amendments. Some of those things to rectify the errors and loopholes of the original act. In the original act, there are so many errors and loopholes are there. To rectify those things, they have included certain things. Then to accommodate numerous amendments proposed after December 2019. As you know, the government announced so many amendments, tax amendments from December 2019 onward. Then those things, they are to legalize through this bill. Then the third thing, to accommodate numerous amendments proposed during the government budget 2021. They announced certain amendments in last November 2020 with relate to the government budget 2021 amendments. Now they have brought those things also into this particular document, seeking for amendments of that. Then when we take these amendments, certain amendments are backdated to 1st April 2018, certain to 1st April 2019, certain to 1st April 2020, certain to 1st April 2021. And some of those things even as at 1st January 2020. They are backdated in most of these things. Then how to legalize? Now once they release a bill like that, after that, they file an order in the Parliament, and thereafter they will discuss it. Then, subject to the committee level amendments, they are passing the law. Once it is passed and signed by the Speaker, that becomes a law. Once it is signed by the Speaker as per our Constitution. Then, now if any public objections are there, the public objections should file in the Supreme Court by way of petition within 7 days, within 1 week of publishing publishing the order, filing the order in the Parliament. Therefore, if any person is interested of objecting this bill, they should take action on or before this Thursday, because Friday is a holiday. I think I have sufficiently explained that part.
Yes, Mr. Ranaweera. Another thing, as I think, as a slide also says, it's an important thing because everybody is more interested about our own employment income. What are the changes that has actually gone in to the employment income?
Yeah, actually, with related to the employment income, there are two important amendments. We will cover those two employment amendments. First one I have put as Section 53C, dental, medical, or health insurance benefit receiving as an employment income was excluded from IT only if the said benefit is available to all full-time employees on equal basis. Earlier, the system was to all full-time employees equally. Now they have changed these words to say it is for in the same category of the service on equal terms. That means, according to the earlier system, if the company is contributing for dental, medical, or health insurance, the same thing should apply for all employees. Under the current situation, for different categories of employees, they can apply different basis. Like clerical staff, different basis; executives, different basis. Likewise, they can do it. It is more practical than the existing law. Then Section 53F, benefits out of the contributions made by an employer to employees' account with pension, provident or savings fund or approved savings society were excluded from IT. Now, the gratuity fund are also included into this exemption. Earlier, the gratuity fund contributions to gratuity funds were not included in this exemption. As a result, now they have brought the gratuity fund contributions also as exempt item. Those two are the main items in the employment income. In addition to that, those abolition of pay tax is there. That's all. That is just abolition of tax. That's all. But normal tax they have to pay.
Okay. And Mr. Ranaweera, are there any other exemptions to income by any chance?
Yeah. We better talk about the exemptions of tax because under this current income tax law, hardly any exemptions. Now, but for a developing country, we need exemptions. Otherwise, we can't cater for the development of the country. Therefore, they again reactivated the Strategic Development Project Act. This was sleeping for 5.5 years or 6 years. Then they didn't cancel the act, but it was not operating. Now again, they started to operate the Strategic Development Project Act. That's a good. Under this act, there are so many tax laws are covered under this law. Therefore, if you are interested of investing in a new project, better to see whether you are qualified to get the approval under Strategic Development Project Act, because you get a lot of tax concessions under that act. Right. Then, in addition to that, there are few exemptions in the third schedule to the Inland Revenue Act. Now they have brought certain new items into the third schedule to the Inland Revenue Act. But we don't have much time to discuss these things, but we will cover slightly. Now, for that, a list of new exemptions under Inland Revenue Act has been introduced into the third schedule. Now, what I have done, I didn't include all those items into this presentation in order to manage 1 hour time period. If you wish to, you can log into Ranaweera Associates website and get it downloaded, because we'll be uploading the full PowerPoint presentation with all these details by tomorrow.
That will be great. I think so. Anyone who's viewing this live stream, please log into Ranaweera Associates website and you will see the complete presentation with all these professional reviews and points. So that will really help you. Mr. Ranaweera, can we talk a bit about the changes on allowable costs, outflows, and losses?
Yeah, we better talk on this matter because under the Inland Revenue Act, Section 10 and Section 11 are much more important in deciding of profit and income of a business or investment, even any other income other than employment income. Then, to these two sections, Section 10 talks about the disallowable items, and Section 11 is to talk about the allowable items. Under Section 10, contribution, now the they have newly added one item into that. It says contributions to gratuity funds by employers are also included into the disallowable list. That means if an employer is contributing to a gratuity fund, it is disallowable for tax purposes of the employer. But that happens only if it is not included into the employment income of the employee. That means the government is not going to lose from both ends. It is adding to the employment income, then the employee is paying tax, then the employer is getting the benefit of allowable expenditure. However, under another section, that is Section 53F, under Section 53F, it is exempted from income tax. The employees are exempted from income tax. It doesn't mean that we have not included. We have included into the salary, employment income, but due to some other exemption, special exemption for them, it is not taxed. It doesn't mean that there's a restriction of the employer to claim. Employer can claim it, right? Then Section 11(4), that is a new addition to treat the cost of funds incurred on loans granted to vocational trained persons of as an allowable expense of a financial institution, to promote the financial institutions to finance the vocational trained people for various businesses, for them to give more and more financial facilities for them. The financial institutions are promoting to give this. For that, they say the cost of such funds by them, they have to gather deposit money by paying interest and give these loans. Then those cost of funds is allowable expenditure. I can't understand why they are repeating it, because anyway under the principle of Section 11, anyway it is allowable. Anyway it is allowable, right? Then under repair and improvements, there's a change in repair and improvements. There's a upper limit of claiming of repair and improvement expenses. We know that repair and improvement expenses of a building, there's an upper limit of claiming per year 5% of the written down value of that building. In the case of any other asset, 20% of the written down value of that asset. If it is not a depreciable asset, no problem. You can claim the entire repair and maintenance expenses. If it is a depreciable asset, only this limitation is there. Now, these limitations are in the existing law. Existing law covers repair and improvements both. But now they are removing the repair expenses from this limitation and keeping only improvements. Now in future, what will happen? The cost of improvements, whether it is capital or revenue nature, the cost of improvements is allowable subject to these maximum limits. Only the cost of improvements. That's a good sign. But all other expenses are allowable without any issue. Then the other thing is marketing and communication expenses. Now, any marketing and communication expenses, there may be capital nature expenses also. But this law says, the bill says, even capital nature expenses are allowable in future. Then the other thing is marketing and communication expenses are defined in the law. That's a good sign. This marketing and communication expenses are defined in this bill. For your better knowledge, better to read that the bill and try to understand the definition of that. Right. Then, allowable and disallowable expenses, there's a limit of claim in financial expenses. There's a limit of claim in financial expenses. As we know, earlier we had this limitation in the case of a manufacturing company up to 3 times of the issued capital plus reserves, equity. In the case of non-manufacturing company, 4 times of the equity. Now they have explained this law. Now explain and change a bit. Now instead of 3 years and 4 years, 3 times and 4 times, now they made it 4 times. Now there's a formula, they have given the formula. What it says is financial cost for the year, you have to divide the financial cost for the year by financial facility value. Then you have to multiply that by 4 times of the issued capital and reserves. Now that means this formula is applicable, this limitation is applicable only in the case of a company having issued capital and reserves. Now what will happen to an overseas company? Under the Companies Act, we can register an overseas company. For general usage, we call it as branch office. Now, in the case of a branch office, what we can tax is the Sri Lankan unit. In the Sri Lankan unit, no issued capital because it's only a branch. Now, in that case, ultimately, overseas companies having branches in Sri Lanka are not subject to this limitation because they don't have issued capital. Generally, they don't have reserves. Therefore, again, they are excluded. Then, Section 19.3. This amendment facilitates to set all the brought forward losses. Now, in the case of a suppose you incur a loss where the applicable tax rate is a lower rate. As per the law, you can't set off against profit of a higher taxing income. But in the case of SME, there are a couple of limitations. Turnover shouldn't be more than 500 million. Suppose after a couple of years, SME became a major company. Then in that case, suppose during the SME period, they incurred a carried forward tax loss. What can they do? They can't claim it. They can't set off that because the next year, the tax rate is not 14%, a higher rate because no SME situation. To accommodate allowing that loss, they have brought this law. As per this law, even the SME situation get changed, even thereafter, they can set off these losses against the future profit. That's a good sign, good proposal. Then those are the main changes. Those are the main changes which relate to allowable and disallowable expenses. I think
Sure.
I have
I mean, that was a good explanation, Mr. Ranaweera. Are there any other changes that you would like to talk about? Anything else that is amended?
Yeah, definitely. What I wanted to discuss is mainly the next few things. Now, there are so many other changes. Out of these other changes, I would like to talk mainly 3 items. But I will explain the other things. Also, Section 36.5. Under Section 36, it is something to do with computation of it says like this. I have put it like this. As per this new addition to subsection 5, effective from 1st April 2021, when an asset is used in the production of different gains and profit. Now one company may have 2-3 different businesses where the tax rate for certain things at 14%, certain things at 24%, certain things at 40%. But we are using our asset resources for all 3 departments, all 3 activities. Now, in a situation like that, it says if we are having that type of a situation, we have to allocate the cost of these assets, the cost what we are incurring during the year among those three businesses on the use of market value. Now, how to decide that is very difficult. We have to apportion those things on the market value, based on the market value, which may not be much practical. Anyway, this idea is a good idea. The other thing is this section, when they drafted this section, the drafting of this section is not up to the level. There are so many weaknesses, language weaknesses in this section. Right? Anyway, they have to rectify these things at the time of passing the law. Then section 38 1A, consideration received. This is also very important for capital gain tax calculations. Now, the consideration received, now what we are doing from the consideration received, we are deducting the cost, then we are getting the profit or loss. In that case, we should know what is the consideration received. Now they have brought this section to say, as per the amendment, the consideration received shall be the higher of the amount received or receivable or assessed value. There are two figures, amount received or receivable. The other thing is assessed value. Out of these two, higher value to be taken as consideration received. Then we'll see what is the assessed value. That is also defined in this law, defined in this bill. It says assessed value means the value at the time of realization certified by a professionally qualified valuer in a valuation report. That's a good sign, because the authority of valuation in Sri Lanka is the certified valuer. That is the professionally qualified person in valuation. Therefore, they have recognized this certified valuer, professional valuer's value as assessed value, Right. Then, but unfortunate situation, that part is superb, but unfortunate situation, it says, however, the tax official is empowered to determine the consideration received, ignoring the qualified valuer's assessed value. That means ultimately, law identified the tax official as the supreme of valuation, That is totally wrong. Because if we have recognized the qualified valuer as the supreme authority of valuation, why we are giving the authority to the tax official to value it? That is not ethical. It is not ethical at all. Actually, this professional valuers association should represent this case. Then I'm inviting them to represent this case before day after tomorrow. Then section 53 1A, with effect from 1st January 20, partnerships, the 8% withholding tax is removed and replaced with 6% partnership tax. I'm not going to talk much on partnership taxes, but I would like to talk a little bit about the remittance tax to manage the time. Now, remittance tax. What is remittance tax? Remittance tax is a tax payable by a non-resident person earning income from Sri Lanka. Now, various people, outsiders, they come and invest in Sri Lanka in different businesses, different investments. Then they earn money and repatriate that money, the profit they repatriate. Once when they are repatriating this money, they have to pay some tax in Sri Lanka. There are two main taxes which relate to this. One is a dividend tax, the other one is the remittance tax. If they have invested in a company, in shares of a company, they have to pay dividend tax on those things. They have to pay on the dividend. If they have not invested in shares, we'll say they create a branch office in Sri Lanka. No issued share capital in Sri Lanka. Now, in that case, the branch office, when the branch office is repatriating their earning, they have to withhold remittance tax. The remittance tax rate is also 14%. They have to pay the final tax of 14% called remittance tax and repatriate that amount. Now, here, if such remittances, if they delay such remittances for 3 years, if this person delayed the remittances by 3 years by keeping that money in Sri Lanka, by investing that money in Sri Lanka, then he or it is getting remittance tax exemption. He can invest in 3 ways. One is his own business to improve his own business. Or he can invest in Colombo Stock Exchange shares or debentures in Colombo Stock Exchange. Then the third option, he can invest in government securities and government security, that is treasury bills and treasury bonds for 3 years. Then need not to pay remittance tax. They can repatriate that money after 3 years, because as a country we are suffering heavily on lack of foreign exchange. Then the other thing is section 83, 84, and 85. I'm not going to explain these sections much. This section 83, 84, and 85 is there to cover withholding tax on withholding taxes, different withholding taxes. Section 83 is to cover the withholding tax on employment income. They brought some amendments into that because they abolished the withholding tax on employment income, what we were calling it as payee tax. They abolished the payee tax with effect from 1st January 2020. Right now, for that they brought some amendments. Then, however, the non-resident persons, when a non-resident person, they have to pay advance personal income tax. If it is a non-resident person earning income from Sri Lanka, has to pay advance personal income tax. In addition to non-resident person, if a resident and non-citizen person wish to deduct advance personal tax, he can advise the employer to deduct advance personal tax. This is not a compulsory withholding tax in the case of a resident or non-citizen persons in Sri Lanka, but optional. But for non-resident or non-resident, non-citizen person, it is he has to do that. Then section 84 talk about the investment income. Investment income. Most of the investment income, the withholding taxes are abolished, other than lottery, reward, betting, and gambling. In the case of lottery, reward, betting, and gambling, the withholding tax is continuing for both resident as well as non-resident persons. Then it is, instead of calling it as withholding tax, now there's to replace with advance income tax. It is advance income tax. Then they brought section 84A as advance income tax to cover up these things, mainly this withholding tax, to replace the withholding tax. Then section 85. Section 85 covers the withholding tax on service fees and contract payments. These are also abolished with effect from 1st January 2020. 1st January 2020. Then section 85 1A, they introduce a new section 85 1A. A person shall withhold tax at the rate provided in the paragraph 10 of the first schedule to the Act, where such person pays dividend, interest, discount, charges, natural resource payments, rent, royalty, premium, service fee, or an insurance premium with a source in Sri Lanka to a non-resident person. That means the person who is receiving should be a non-resident person. That is the requirement. If it is the situation, this advanced income tax is, they have introduced advanced income tax. Then section 87 talk about the withholding tax certificates. Then section 88 talk about the final withholding tax. There are certain withholding tax considered as final withholding tax. The withholding tax on lottery, reward, betting and gambling continues to be a final withholding tax. Then payment to non-citizen, non-resident persons subject to withholding tax other than payments derived through a Sri Lankan PE also continues as fine. Then interest paid to or treated as derived by a Sri Lankan citizen non-resident individual excluding the following, excluding the 3 million personal allowance, because they are getting, Sri Lankan citizens are getting 3 million personal allowance. Exceeding 3 million, they have to contribute for advanced personal tax. Then I think I have sufficiently explained those things up to now.
That's right.
Yeah.
Mr. Ranaweera, I think the hot topic these days by professionals is the need to submit tax returns. Can we talk something about that? Because everybody is, concerned, worried, asking a lot of, there are a lot of doubts about this. So it will be helpful to talk about it.
Yeah, that is the most hot point nowadays. We have another almost 24 minutes. I will manage to explain in depth those areas. Now, if we'll see our Inland Revenue Act, under section 120, we are supposed to prepare accounts and records. Now, this section also they have proposed to amend. They propose to amend section 121A, amending to make mandatory the maintenance of financial statements in such a way to identify the taxable income separately. Here the important thing is taxable income separately to facilitate of applying different tax rates. As we know, now under the Inland Revenue Act, we had single tax rate system. For the company, one tax rate. But I can't say one. For capital gain, anyway 10%. For liquor, tobacco, gambling, 40%. For other things, one rate. But again, we are moving to apply different rates depending on nature of the income. Again, we are moving the situation which was there in the old act. Now, to facilitate that, it says if we are having any income which is to be taxing at different rates, then we have to prepare accounts in such a way to recognize the taxable income separately for different sources. That's a good thing, because otherwise we can't apply the tax rates. Then the most important part, actually today the most important part is section 126 and section 190. First, as I start, I will start with section 126. Section 126 says filing of tax return. This section is amending by stating as to improve the clarity. It says to improve the clarity, but that is not the truth. It says to improve the clarity, but they wanted to increase the coverage. Mainly to expand the coverage, they are proposing something. Now we'll see. And if you'll say section 93, read along with section 94. Subject to the restriction, subject to the instruction by Commissioner General, every person requires to file a tax return of income or capital gains. Every person requires. There are some exclusions separately, but it says every person requires to file a tax return on income or on capital gains. That's the requirement. Then section 126, that means now basically once we once we apply the exclusions, all people who are having taxable income and all businesses and companies and all, they should file the tax return. Now, The section 126, there are a couple of subsections in that. The section 126(5) of the existing act, it says, as per the existing act, it says, a person prepares a tax return for a reward. A person prepares a tax return for a reward, also to sign it. That means somebody like professionals like us, if we'll prepare a tax return of one of our client for a reward, if I'll do that, I should sign the return. Whereas a few professionals may have already signed accordingly. Now, with this requirement, some professionals may have already signed. There may be certain reasons for these things. One reason, we'll see why. Now, a majority of the professionals didn't sign the tax return because of this sentence. Because what it says is, prepares a tax return for a reward. As we know, professionals never provide services for rewards. We always provide services for service fee. Now, the difference between service fee and a reward is, service fee, we after providing the service, we raise a bill to the client for the service. But in the case of reward, you give some services to a client, where suppose the client is satisfied with that service, client will decide and give something. It is not a fee, it is a reward. Then in that case, whether it is legally or otherwise, we have to satisfy our client to get more reward. To attract more reward, we have to satisfy the client. That means it is not covered with the profession. Professionals shouldn't work for reward. Should work only for professional fee. Now we will see what may be the reasons why certain professionals sign the return. It may be due to misunderstanding of the law. Some professionals may have not understood the difference between the rewards and the fee. As a result, they may have blindly signed the return. Then it may be, though it is not ethical of providing services for rewards, there may be some professionals who may have done so, because professionals are also a fraction of the society. Therefore, there may be certain professionals who has provided services for a reward. If they have provided services for reward, they may have already signed the returns. There may be some other reasons. We don't know. Right. Anyway, a few professionals may have signed, majority not signed. Now we'll see these sections. Section 126.4 and 126.5. The Arabic letters gives the extract of these sections. It says, a taxpayer or a taxpayer's duly authorized agent shall sign the return attesting to its accuracy and completeness. Taxpayer or his agent, because when agent sign, taxpayer is responsible, shall sign for the attesting of the accuracy and completeness. Obviously, because that is his return, then he should sign for the accuracy and completeness. Then what the professional should do? That is 5. It says professional should sign the tax return if he is giving the services for a reward. One condition is that if he has given is working for rewards. And at the end, it says, other than the person, shall also sign the return. Shall also sign the return. Earlier sentence, shall sign the return attesting the accuracy and completeness. That means the original act did not expect the professional to certify the accuracy and completeness. Even the professional signed the return as a result of working for a reward, need not to sign the return for accuracy and completeness. It is just to sign the return as prepared, because prepared, then as per the law, it is the situation. But unfortunately, what has happened? The Commissioner General is the one who is drafting these tax returns. When he was drafting 2018-19 tax return, what he has done, he has given one statement to sign for both parties. Now, under 126.4, the taxpayer should sign. 5, the professional should sign. Now, what the Commissioner General has done, in one, for the accuracy and completeness, the other one is for the preparation. But unfortunately, when the Commissioner General drafting this tax return, he has included part A for the taxpayer, part B is for the professional. One sentence at the top. Then it says the correctness and all those things are there. Then whether the return or part of the return prepared by other person, yes. If we'll tick as yes, then the professional should sign in the B. That means ultimately professional is signing for this sentence, which is totally wrong. The presentation, this drafting is not in line with the Inland Revenue Act. Then we'll see what has happened in 2019-20 year. Because as a result, majority of the people who understood this error didn't sign this part B. That's good. Then this is an extraction of 1920 return. In 1920 return, what he has done, he put two statements for taxpayer separate statement, for the professional separate statement. But still, in that separate statement, what he has mentioned is, I declare. Now, if you'll read this part, it says, I declare to the best of my knowledge and believe that all particulars furnished in this return of income are true, correct, and complete. How can we certify that these information are true, correct, and complete? For us to certify like that, we have to do a verification. We have to do investigation or checking of these figures. We have to verify the figures. Without verifying figures, how can we certify that? Therefore, in 2019-20 statement is also totally wrong. As a result, the professional who understood this error didn't sign this certification. Still, now with the latest situation, what's happening? Now, with the latest situation, now they are changing these words to rewards to any payment. Now, this with the new proposal, now it is amending to extend the requirement of signing the tax return by preparators, fillers, and assisters who are giving those services for a payment. With the latest proposal, they have changed these words also. Now, by reading these words, the persons who are preparing, who are filling the return, and who are assisting to the taxpayer to fill the return are responsible, should sign it. At the same time, instead of the word reward, they have brought the word for a payment. That means even the professional fee is covered here, right? Now, the requirement of taking responsibility of an unknown and non-verified information providing by a taxpayer is not fair and not in line with the constitution of the country. Now, we have a constitutional right. We being the citizens of Sri Lanka, we have constitutional rights. Now, with this amendment, they are violating the constitutional right of the taxpayers and the professionals, mainly the professionals. Further, the taxpayer is paying fees for advice in computing and for filling the tax return with the figures provided by him, and not to verify the correctness of the information so provided, and hence now the taxpayer is not paying us for verification. Taxpayer is paying us for advising, filling, and filing the tax return. Now, in that case, we are not getting the fees for verification. In that situation, government is expecting us to verify it. Then in that case, government should pay us for the verification. They have to draw the law to advising us, instructing us to verify it. Then they should pay professional fee for the verification. Right. Saying that, I would like to go forward to section 190 and section 190A. Now they are bringing a new section to section 190A, bringing a new section. Impeding tax administration, that is the wording what they have given. Insert in a new section as section 190A to introduce punitive provisions in relation to the auditors. To whom? Auditors, tax practitioners, tax advisors, or approved accountants. Right. Now, first of all, we'll read section 190 and see the existing one. A person who, that section 190, if you'll see the section 190, if anybody willfully impedes or attempts to impede the department, then they can charge penalty and take legal action. Right? 1 million penalty and imprisonment they can do. Willfully or attempts, if they'll do that, that's fine. It should be there, because if we are doing anything willfully, should fine us. Then in the section 190, there are a list of items to support this willful events. Fail to comply, various wordings are there. I'm not going to read all these things. The various errors or willful events are listed in this section. Right? Then what is the amendment? Now we will concentrate on the amendment to manage the time. Any auditor, tax practitioner, tax advisor, or approved accountant, 4 people are there in this, other than a full-time employee of the taxpayer, who, what he has to do, prepares, fills, certifies, assists in preparation, filing, and certifying the tax returns, accounts, records, appeals, and objections, or any other documents or information to furnish to the Commissioner General. That means a professional, these 4 category people may prepare, fill, certify, or assist in doing various work like that. Even the appeals and objections are covered in this. We have to keep in mind that appeals and objections are also covered in this. Then B, it says, intentionally disregards or fails to take reasonable care in discharging the professional duty, or fraudulently prepares and certifies such document or information, or deliberately misinterprets any provision of this act or any other act administered by the Commissioner General, or any regulations, rules, or other made under thereunder. Now, intentionally, very strong words, intentionally, fraudulently, or deliberately. Then the other thing is, this covers not only Inland Revenue Act, to see any other act. I don't know whether it is possible to do that, but they have brought any other acts also into this. Right? That means the Inland Revenue Act is trying to supersede any other act. Ultimately, now if we'll take Strategic Development Act, Project Act, it says it supersedes all the other assets. Now in the Inland Revenue Act also says Inland Revenue Act can supersede the other acts. These two are not matching. These are not matching. Anyway, then commits and offense under this section, and these are the penalties. What are the then under this act, and on conviction after summary trial before a magistrate, be liable to a fine. I have put these numbers for India understanding. A fine not exceeding 1 million rupees, or imprisonment of either description for a term not exceeding 6 months, or for a prohibition order preventing him from practicing in such capacity. It's a peculiar word. It's a peculiar statement. Anyway, those are the wordings what they have used. Now, these slides, the things what I have explained, the numbers are given in this slide. Coverage of person, auditor, tax practitioner, tax advisor, approved accountant, then coverage of service prepares, files, certifies, and assists, then auditor, then intentionally, fraudulently, and deliberately, then they can charge a fine, imprisonment, or prohibition order preventing him practicing. Now, I would like to take maximum of 10 minutes to explain this and finish it off. These are the concerns what I have. These are my personal views. I thought that it is better for me to explain these things for your better understanding. These are the questions what I have. Related issues. Is the loading of such responsibilities to an auditor, tax practitioner, and tax advisor or approved accountant fair and correct? Whether these things are fair or correct. Now, somebody is asking something from me what I can't give. Is it fair? Suppose somebody come and ask my life, can I give my life? Something like that. It is not correct at all. Then number two, can it be done under the constitution of the country? Because I don't think, according to the constitution of the country, this is correct. This is not according to the constitution of the country. Then number three, who is a tax practitioner and tax advisor? It is not defined. Without defining, they are trying to tell something. It is totally wrong. Then number four, who is paying to these listed persons? Now, for these persons, for us, for we all, we are getting the fees from the client. Then, in that case, to whom they should provide these services? We should give the services to the client, not to the government. We should provide the services to the client because they are the people who are paying us. Then we have to give professional services for a fee to the client. Then, is the government ready to pay for additional services expecting from these persons by this amendment? Now, government is expecting a lot of services from us without offering money. Is it correct? That is totally wrong. Then, can any of these listed persons take responsibility of the information not verified by themselves? Can we certify these things without verifying? It is not, we can't do. Which law requires him to verify those information in Sri Lanka? I don't think there's a law requiring us to verify these things. Then if so, why the law expects a thing which cannot be done obviously? Then is the section 198 drafted properly and legally to cover the expected goal? I don't think it is covered the expected goal. There's something wrong at the drafting level. That is what I feel. I don't think the politicians, the ministry level wanted to do like this. Then isn't it create a tax fear which will adversely affect to the application of tax law? Tax fear is a serious thing in a country. We shouldn't allow to create a tax fear. This section create tax fear. Does it want to create a fear among the professionals not to provide services in relation to appeal in an objection? Once we created fear on the professionals, then they'll not be in a position to represent for appeals and objections. Easy game, because then no appealing, no objections. Then by using the words intentionally, fraudulently, and deliberately misinterpret, is there any assurance that some tax officials may not misuse those things? Now, why they are asking all these things from the professionals only? That is totally wrong. Then, if misused, isn't it result the wasting of taxpayers' money and productive time in challenging. Suppose a tax officer has taken an action against a professional to harass him. Now what will happen? Unfortunately, this professional has to go to the magistrate court and get justified there and wait for a judgment. Is it correct? I don't think it is correct. Then how come any other act covers with it? Is it, now it covers all the other assets. Acts, I don't think it is correct and fair. Then who has granted the practicing license and who could restrict it? Now, our practicing license are issued by a professional body. That professional body is to represent the members of the professional body and to maintain the professional standard of that profession. Now, if it is the situation, the license is granted by the professional body or bodies, but trying to restrict it by somebody else, whether it is correct. With the above restriction, what is the use of having professional bodies? I have a doubt why we need a professional body when somebody else comes and interfere into the professional body, when the professionals, the members of that professional body is doing the correct professional acts. Now, those are the issues what I have. I would like to give little time if there are any questions for me to answer.
Mr. Ranaweera, thank you very much. I think it's a very lengthy explanation, and also you talked about the possible legal implementation or possibility for litigation kind of things for professionals. As of now, I don't think we have any questions raised to us, but I think we should tell all our viewers to stay tuned for the Tax Talk episodes on the Facebook page, which is shown at the bottom. Follow Ranaweera Associates on Facebook. Also, you can type Tax Talk on YouTube and subscribe. Press the bell button so you can be notified of any updates, any new Tax Talks. And as Mr. Ranaweera mentioned, the slides will be on the Ranaweera Associates .lk website. So it goes as ranaweera.lk. So please visit the website and you can download these presentations and have more details. So you can take your time and go through it. So I think, Mr. Ranaweera, ending this financial year, we've conducted several tax talks which have been come in very handy and been mentioned as very important. We see comments on Facebook and YouTube. So I think with the new financial year, with the new amendments, the new changes, there might be, I look forward for seeing some new things and new areas. So also I think it's important for the viewers to kind of message us and tell us what sort of interest they have, what sort of topics that Mr. Ranaweera should cover. So I think wishing everyone a very happy new year and a new financial year. I think we can probably end our tax talk today, Mr. Ranaweera.
Yeah, before ending, I would like to thank everybody for giving me the opportunity to share my knowledge. Thank you.
Thank you very much, Mr. Ranaweera, and thank you very much everyone who has tuned in, who was going through our presentation. Once again, wish you all the very best, and we'll see you in a new financial year with Tax Talk with Mr. Ranaweera again. Thank you very much and have a good night.